Cool. So it's past 8:05. Thank you everyone for coming. My name is Aaron. I'm the guy who writes the blog, Mr. Stingy. Wai Ken here is the country manager of StashAway. Today
Hello.
we are here to Today we are here to speak about investing in difficult times. I think it's going to be lots of fun. I've got a ton of questions to ask Wai Ken actually.
Yep.
But maybe let's just start by Wai Ken. Maybe you introduce yourselves, and then let's go from there.
Thanks, Aaron. So for everyone, thanks for joining us as well. By now, you probably have ran out of things to watch on Netflix already, so I'm not surprised you guys are here. And if you guys have any money in the stock market, I think you guys are also looking for clarity, for some direction, or maybe some reassurance. But just a bit about myself. My name is Ken. I have known Aaron since I started working with StashAway. I have about 10 years of experience in the financial institution space. I started with Khazanah in their investments department. Then I moved on to become an investment banker at Affin Hwang for 5 years. Then I joined StashAway. It's my second year here as country manager. So for those of you who are not sure, have never heard of StashAway before, basically we are what's called a robo-advisor or a digital investment manager or a digital fund manager if that's what you prefer. So basically what we offer is a really simple and affordable way to invest your money. We also get rid of a lot of the costs involved usually with investing. Things like sales charge we do away with, so ultimately you get a better return. But in terms of things to do, all you need to do is basically download an app and then choose your portfolio and then deposit money and off you go. Obviously, we really invest a lot of time in trying to educate the public.
So I think a really great. Sorry, I think there's a bit of lag there. So Wai Ken, you mentioned you are a simple and I guess automated way for investments, right?
Yeah. So I think normally when you think about investing, you think about talking to an agent or going into a branch. But with this wave of fintech and this wave of digitization, we are basically a licensed fund manager by the SC, the first to be licensed in Malaysia. And we make it very easy for people to invest. So all you have to do is sign up on a website or download the app and start investing.
Cool. Thanks. So great introduction. Again, guys, if you've got any questions, feel free to put it in the question and put it in the chat group. I'll get to them later. We'll have a question and answer session later. Again, we are here today with Wai Ken, country manager of StashAway. I've known him for, I guess, more than 1.5 years now, almost 2 years, right?
Almost 2 years. Yeah.
And really great guy.
Time flies.
Yeah, so pleased to have Wai Ken here. So I think to start off the conversation today, right? A lot of people are interested in the algorithms behind StashAway. I think it comes from the fact that probably markets have crashed in the past few weeks.
Yep.
Probably some people are facing portfolios with negative returns. And there's a lot of questions around StashAway in terms of their algorithms. How do you guys do that? Do you have anything that you can share about that? I guess if you want to share your screen,
Yeah, of course, sure. So the way StashAway works is we have 12 different portfolios, and all these portfolios are built using ETFs. For those of you who don't know, ETFs are exchange traded funds. And the whole point of an ETF is to replicate an index or an asset class. So we take, let's say, an index like the S&P 500, buy one ETF for that, one ETF for bonds, one ETF for European equities, one ETF for gold, and then we put it all together into a portfolio for everyone to invest in. And like I said, there are 12 different portfolios for you to choose from. So obviously we don't stop there. It's not just a static portfolio of ETFs that once you get it is yours forever. Your portfolio is not your spouse. You can change your portfolio anytime you want. You're not married to your portfolio, right? So through different market environments, you might see us actually change the asset allocation of these portfolios. So the way it actually works is that there's an algorithm, and behind it, It's called ERA, or Economic Regime-Based Asset Allocation. So it's a bit of a mouthful, so I will share the reading materials from our website there. But what it basically does is that it gives you the best portfolio for the current economic environment so that you can actually invest through the cycle. Investing long term is one of our key principles. So obviously we go through our lives with going through many different economic cycles, right? For some of you, maybe you've gone through the global financial crisis. Going back a bit, you've gone through the dot-com bubble. In Asia, you've gone through the Asian financial crisis. So it's really important to invest through the cycle. So our algorithm looks at economic data. I can go into a bit more detail about why we choose economic data later, but it takes into account economic data to determine where we are in the economic cycle. Okay. And we also look at certain technical and also valuation metrics so that we can change the asset allocation ultimately for your portfolio. I will say off the bat that it's not a get rich quick scheme. It's not a sure make money thing, guaranteed returns or anything like that. It is for you to get broad diversified exposure to many asset classes all around the world. So we can go into it later in more detail.
Cool. I guess personally for me, I really enjoyed investing in StashAway because for a long time I was looking for a low cost way to invest. Those of you who read things by Jack Bogle, or you're fans of Vanguard kind of investing, you'll know that typical unit trust charges are super expensive in the country. I was waiting for something like StashAway for like the longest time ever. So actually when robo-advisors first started in Malaysia, I was like super excited. And I think that's when we started talking, and then it's worked out great so far. So a bit more on the algorithm, right? Wai Ken. I think how has the coronavirus kind of thing affected this algorithm? Are you guys, how often do you change it? It's like monthly, weekly kind of thing?
Yeah. So to answer that question, basically we do two things. One on a daily basis, almost daily basis. Another one is actually more rare, on a yearly basis, or only when only when required. So the first thing that we do almost on a daily basis actually is called rebalancing. So rebalancing is not anything new. Basically, any portfolio manager will do it. But what it does is it keeps your portfolio risk constant. So for example, if you, let's say, have a portfolio of 50% bonds and 50% stocks, and then now say stocks go down by quite a lot, so your portfolio actually become more dominated by bonds. So what we do actually is we rebalance by selling some bonds and actually to reintroduce more equities, because obviously equities is now a smaller portion. So we keep the proportions the same. Rebalancing is nothing new. It's just something that's done on a daily basis if need be. What we do, which is very different to everyone else, is like I shared in the chat group, is ERA, and we do this thing called reoptimization. So reoptimization takes into account the changes in asset allocation. To step back a little bit, asset allocation is the thing that sophisticated or intelligent investors do to actually target the risk of any portfolio. So if you look at EPF, you look at PNB, you look at all your big fund managers out there, they focus on asset allocation. Asset allocation means how much risk do we want to take? And based on that, what assets do we choose? They don't think, oh, Maybank is a good stock. They don't think, oh, okay, Tenaga is a good stock. Let's buy that and hope it goes up. It's not as random as that. So they look at asset allocation. So the way it works is we take into account economic data to make sure that we know where we are in the cycle. Because things change very fast, and obviously with events like this coronavirus, there's a lot of I would say a lot of pressure, or a lot of expectations that we will automatically change things all the time. But actually, since the coronavirus has hit, and basically the markets, since late February, have gone down to even minus 30% since its highs in late February. And I'm talking about the S&P 500 here, the US market, gone down 30%. Locally, things have also been pretty bad. I think we've been down almost 22% in this year to date in Malaysia. So there might be an expectation to like, oh, change the asset allocation or do something. But basically, in terms of the algorithm that we use, in terms of data we are seeing, we actually are staying put. Okay, for this, I want to share my screen and to show you why exactly we are staying put, okay? We are staying put because we need to make sure we know where we are in the economic cycle. And the main reason why we are invested in the current portfolios which we are in now and haven't really changed it is because of this main thing. Okay, a lot of words, I know, but basically we have learned from a lot of financial crises, right? We've learned from the '08 crisis especially. And when you look at the '08 financial crisis, you see in the blue line how bad it went before policy stimulus actually comes in. Policy stimulus just basically means things like the 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 Treasury, the Federal Reserve of the US of America actually doing something that is extraordinary. Normally they just look at interest rates, but now they're actually looking to do what's called quantitative easing, basically buying a lot of bonds, injecting liquidity to buoy up the markets. And we can talk about that a little bit more. But the reason why it hasn't changed is because when you see here the blue line, the policy stimulus was introduced almost at the bottom of the global financial crisis in '08. So you can see in the orange line how sharp the decline has been for this coronavirus. And this coronavirus is not alone. The coronavirus also is paired up with the oil shock, which was a 30% drop in oil prices to around $30 per barrel now. So that's also causing a lot of sectors to go under. So you can see the speed of the velocity which is happening now in the the orange line here is very shocking, right, to a lot of people. But the good thing is that these policy bazookas, as we call it, is a term that was coined in 2008, these policy bazookas. Basically, they've started now. So if you basically just Google America stimulus package, 1 trillion, 2 trillion, you will find out what I'm talking about. But there's governments all around the world who are planning to come in to do all sorts of different programs to support the economy. So when you support the economy, it will have an impact on the economic numbers that we see. And the last thing that you want to do, and we want to do, is to just preempt and forecast and guess what the numbers will be. So before the numbers are even come out, because economic data is lagging, meaning it's happening in the past, we'll get it in the future. When we get it, we don't know whether it's -10, -1, -5, -50. We don't know. So the reason why a lot of active fund managers don't outperform the benchmarks is because they try and take positions to preempt, to forecast, to guess, right? Basically, if they guess correct, they look like gods. If they guess wrong, then they look silly, and they still collect fees anyway. So what we do is basically we wait until the economic data comes out, and we are not doing anything right now, anything special, because we are seeing a lot of these policy bazookas come in. So I can talk more about this in depth, but to come back to your earlier point, I want to stress that because we take economic information, we need to wait until we see some leading indicators about how bad things are. If we preempt, we might be wrong, and we might be positioned in a portfolio that may not be able to take advantage of the full recovery. So just imagine we see that sharp drop, right? And then we switch your portfolio to something safer to cap your losses or to limit your downside. And then suddenly all these policies of bazookas come in, 1 trillion, 2 trillion, right? There's all these quotes like whatever it takes, right? These things are very exciting for the market. And then by the time you're already in bonds and gold, and when markets rally like they did 2 days ago, best performance in 1 day since the 1930s. It's ridiculous. We are in a very volatile time. You will not benefit from the rally. So what we're doing is we only change the asset allocation as and when it's needed. Okay.
Cool. Yeah, I think I've asked you this before, Wai Ken, in a private conversation, right?
Yeah.
I think the way a lot of people often look at robo advisory, like sort of like an active fund manager, like they're constantly not even like an active fund manager, right? They look at it, maybe they think that a robo advisor or StashAway is something like a active trader, like it's swing trading, right? Go up, buy low, sell high, that kind of thing. Whereas I think for me, and you can correct me if I'm wrong, a robo advisor is more something that you invest for long term, say 10, 15, 20 years. That's what you're looking at, right?
Yeah, so StashAway is as you rightly mentioned, is a long-term investor. I think people really need to understand what they are investing their money into. So if you're looking for something that is a short-term trading vehicle, maybe you can look at some aggressive fund managers out there, or you can manage your own fund, or you can learn how to actually trade, do day trading or options trading or FX trading. What StashAway is very good at basically is to make sure you get diversified portfolios, and I'll talk a bit more about that later, so you can actually invest for the long term. It's not to give you ridiculous returns in 1 year and then you like just cash in and retire straight away. It's not that kind of platform. It's meant to give you nice, steady returns on average year on year so that you can invest through the cycle. So a lot of the times people are focused on past returns because that's the only thing we can look back on and judge a platform whether it's good or not. But realistically, you have to wait a few years to really see whether this platform is doing what it's supposed to do. So just to share with you some performance numbers. In 2019, it was a very good year for markets. So basically, we did tremendously. We did very well. Our low risk portfolio did 14%. Our high risk portfolio did like 33%. So that's amazing, right? But then you see in down markets like this, year to date, our portfolios, the conservative ones did plus 2% because it's mostly in bonds. And then the most aggressive portfolio is down around 20%. So you see those swings are what is what is supposed to happen. In good years, aggressive portfolios will give you high returns. In bad years, aggressive portfolio will give you worse returns. So what we try and educate people is that if you choose the risky portfolio, know what you're signing up for. Look at the constituents, see that they're mostly equities. Go towards the balanced one, compare that to your risk appetite, right? There are bonds in there, gold, some safer equities. Then you look at conservative ones, like mostly bonds. In good times, it's really not exciting. But in bad times, you walk around, like you're like bulletproof. So it's really down to the individual ETFs that we invest in. So before you invest in any platform, not just StashAway, also look at what you're actually investing in.
Cool. Yeah, I think that's great. And it's interesting to hear about the few what do you call that? The oil impact, the coronavirus. I'm curious, right? You mentioned it briefly. You said that this is the highest velocity sell-off that we've ever seen, right? In terms of the US stock market, like the graph is literally gone from
it's almost minus, like vertical.
Almost vertical, right? Like, can you maybe help the layman? And I think there are a lot of young people in this channel today. They may not be super versed with economic terms, right? In a layman theory, like basically what WTF, what the fuck's going on, right?
I think it's good to have perspective, right? Because having perspective, then you can look at your investments and express that view. Investment is you expressing that view. So before you express any view, you must know what the hell is going on, right? So basically, in terms of what's actually happening, obviously we started with a virus, right? So the virus started in China, made its way to around the world, and is now most heavily impacting some European countries and also the US. Obviously, the US is such a huge economy, so naturally its stock market is also bigger and it's harder hit. So, just to give you some very, very scary numbers, the S&P was down like 30% basically in like three weeks. And when we saw a lot of huge swings, like huge percentage down and then huge percentage up, huge percentage down, huge percentage up. Okay. Because the stock market is a voting machine, or it's like a popularity contest, right? So if times are good, then you'll see the index do very well, especially equities. If times are bad, then you'll see it do very, very badly. So it's an emotional gauge, if you like, of what people expect the economy to do, what people expect the different businesses out there will do. So when anything happens, good or bad, big or small, you will see the market price things in. So if you hear things like factoring in, pricing in, basically it's the market digesting the information and trying to change their view based on this new information. So it's like let's say you go out, you go on Tinder, you find someone, oh look very nice, okay, rate very high. Then suddenly you find out, oh she has like eight cats. Eight cats is seven cats too many. Then you rate her down like a bit worse. And same she's doing with you lah. Like oh okay maybe your picture looks good, so you go out with you. Then you show up, you're like massive and like out of shape. Then like oh then she rate you lower, right? So it's the same with in terms of sentiment when it comes to the stock market, right? People rate the information that they digest and then they price things, whether it's buying or selling. So it's actually not precise and basically it can be very volatile place. And when you have a huge crisis like this coronavirus, which is wide ranging and hard hitting, and there's an added element of emotion because people are dying, people are suffering. So the S&P and equity indices around the world are trying to process how bad it will be for the economy, right? So it's trying to find where is the right price for the economy given this new information. And then along the way, there was an oil shock. Oil shock was started because the OPEC members couldn't get along. There's some geopolitical agendas where Russia can't agree with Saudi to cut production because they want to screw the shale oil producers in the US. So basically, they flood the market. They meaning the Saudis, they flood the market with a lot of oil, billions of barrels, so that the price went very cheap to cause Russia some pain. And basically, what that meant was that every kind of oil-related economy around the world, an oil company in any market will also get downgraded massively. So that if that goes down, then obviously it pulls the market down some more. So you just have to understand that the stock market is a voting machine. Like if there's bad events, good events, you'll price it in. It doesn't mean to say that whatever is priced in is correct or wrong, but it's trying to find the right level. Okay, so that's what has been going on briefly.
Cool.
But
yeah.
go on.
Sorry, I cut you off. Yeah, go ahead.
No, go ahead.
Yeah. So I mean, there's something I always read, right? And I'm super curious about this. It always starts with it's the negative yield thing, right? And again, this concept of yields and bonds is a bit confusing. I spend a lot of time reading it, and I always have to revise. What's this new world of negative bonds? It's always confusing to me, right? Because the theory is that if I loan money, if I buy a bond, I should be earning interest on that. But governments are like cutting yields, are cutting interest rates left and right, right?
Okay.
So how does this actually change the equation and
put things into perspective? It all starts with the central bank. Okay, so the central bank basically determines the price of money, and the price of money is basically your yield, right? Because when you go to the most common analogy is your FDs. If you go to FD, you will basically see the rate that's very close to the interest rate. So the monetary policy or the central bank sets how expensive money should be. And obviously, when it tries to go through tough times, what it wants to do is to bring yields lower to make the price of money go down so that the market is more incentivized to invest and to spend. So imagine if I told you, hey, this loan is only 1%. And you'd be like, oh, I'll invest in a house. I'll invest in 2 houses because it's basically giving money away, right? But then when rates go too low, that also means that people don't have anywhere to hide. Meaning, if I buy bonds, then it already give me 1%. So there's not a lot of incentive for me to do so. So I put a lot of money in equities because I hope that the stock market will give me better returns. So when stock market goes down like it does now, then a lot of people are like, okay, screw negative returns. I'm just going to go for low guaranteed returns. So they go back to bonds to go for that 1%. But then when bonds are traded and everyone is going after that bond, the price of the bond goes up and naturally the yield also goes down. If I promise to you, because you buy the bond for 100 and and I give you 1 ringgit, that means it's 1% a year. But then someone comes to you and say, I give you 100 ringgit and 50 cents. So yeah, okay, I can make a capital gain. I can make some money. I sell my bond to someone else for a higher price, and that person who gets that more expensive bond will get a lower yield because they pay higher for it. So they will get close to zero yields. In terms of negative yields, it's really where economies are like so desperate to get money out into the market and to get people spending again, that they say that I will even tax you or charge you for giving me money because I really want to incentivize you to spend that money. So when people go and buy those bonds in Germany, which are like negative yield, maybe like negative 1%, it basically says that people just want to put their money somewhere where it won't go below 1%, below negative 1%. So I think for individual investors, you start just to frame it all in your head. It is important to understand that a lot of things in this world is tagged to interest rates. So when you see Bank Negara cut interest rates, it's because they want to spur the economy. You see them hike interest rates, it's because they want to slow down the economy and slow down inflation. Otherwise, things get overheated and then you might get a bubble situation. But not the economy is not a perfect science. People don't necessarily always do what the central bank wants them to do. So in the short term, you have all these different dynamics. So and when it comes to interest rates and all that, find out for yourself in your personal portfolio whether you're getting a good return or not based on the risk-free rate that you're getting. Risk-free rate is your FD rate. Because you put something in FD, now you get 2.6, 2.5%. That is virtually guaranteed, so there's no risk. So do you want to invest in something that gives you 1% in this environment? No, because you can put your money in FD. Do you want to put your money in stock market now? Probably not, because you go negative. But also, it depends when you buy, so your performance will be better in the long term when it comes to equities. So you have to look at things long term. When you do benchmarking, you have your interest rate, your FDs, which have been averaging around, say, 3%, 4% last few years. Then if you invest in equities, then it should be 5+%. If you invest in bonds or gold, it should be a bit more than that because there's some risk. EPF gives you around 6%. So just to wrap this up, just to give you some benchmarks. So the US market has been giving us around 11% a year for the last 10 years, which includes this crisis, by the way. So it's already down a little bit. And then you have your FDs, which is around 3%, now less, 2.5% now. And then you have gold, which has given you around 4% in the last 10 years. And then you have maybe some REIT yields, which give you 5%. EPF will give you about 6%. Property gives you around 5%. Bonds, on the other hand, you don't only have to look at your coupon, but you also have to look at the price of depreciation in your bonds. But basically, bonds give you around 2% in returns. So
Yeah,
long story, but basically
yeah.
just tag it to your risk-free of FDs.
Yeah, it always blows my mind, right? Because I was reading some research, but I think it was I forgot. I think SC came out with some research, and apparently a large percentage of investors think that 30% returns a year are acceptable returns.
No, that is very, very not very good expectations, lah. I think if you go into something thinking that 30%, that's not the right expectations.
Yeah, I think that's why maybe a lot of Malaysians are susceptible to skim cepat kaya, because
all these scams.
5-6% sounds like 5-6% is like pretty crap in a lot of people's minds, but actually it's I guess it's the normal or even good, right?
Yeah.
Cool.
Sorry.
Yeah. I've got a question, right? And again, this is a bit of a personal interest kind of question. I know the audience probably has lots of questions to go.
Yep.
But let me ask you a little bit about quantitative easing. I keep hearing this term, right? I keep hearing that governments are printing money. A little layman explanation on what quantitative easing is actually.
Yeah. So quantitative easing, or commonly known as QE, is one of the many things that a central bank can also do. Besides hiking or lowering interest rates, they also can do a lot of things in the financial system. Okay, so you also have to understand that governments, you have two parts. You have monetary policy, which is the central bank, and then you got fiscal policy, which is the government in charge, the parliament and the senate and all that. So quantitative easing is basically the central bank buying bonds from the federal government. So when the federal government wants to do something, for example, like in this situation where they want to prop up the economy, they want to they want to give out emergency loans to airlines. They want to give people $1,000 checks in the mail so they can go and buy things to stimulate the economy. They want to um, they want to spend billions of dollars on the healthcare system to boost the health infrastructure. All this is basically borrowing money or printing money. So when they print money that time, they cannot just print money and then like pay themselves, right? So the way governments do it is basically they sell bonds. They sell bonds, and because the size of the bond market usually is a certain size where there are a lot of investors. But when you are printing a lot of money, issuing a lot of bonds, you have to have someone bigger to buy it. So the person who can buy it is the Federal Reserve or the central bank. So the central bank is basically taking on the federal government's bonds so that the federal government can go about doing its economic stimulus. So it's also not very clear what's the long-term effects of QE, and there's a lot of economic papers out there which show that it's not really a science as well. So but I could tell you what it's trying to do is to basically stimulate the economy, to have the government pump money into the system by buying a lot of bonds, so that the federal government can do a lot of things, can provide infrastructure, can bail out companies to do things like that. It's not quantitative easing is not a directly handing out money. It's not directly like that, and also B is not directly injecting money into the stock market to like buy stocks, so is that's not really how QE would work lah.
Yep.
So in short, basically you have to recognize that there's two entities in the government, and it's left hand and right hand. When fiscal policy or the federal government wants to do something, it cannot just like, oh, where am I going to get the money, right? So I have to borrow from investors. And when you don't have as much investors, you turn to yourself, your left hand, the monetary policy guy, the Federal Reserve, to basically buy your own bonds, right? And it's actually not a new concept because Japan has been doing this for many, many years. It's just that the US used it and became popular after the global financial crisis in 2008 to make sure, firstly, that we don't go into a depression and a deep recession. And second of all, is to actually like buoy up the markets and spur economic growth.
Cool. So if I understood you correctly, right, Ken, actually the government, no, the economy needs some level of spending, or money needs to flow in the economy, right, for it to work. I think that part I can understand.
Yeah.
But there's almost like a conflict, a personal conflict, right? Because in tough times, people don't want to be spending money. People want to be saving money, right? So actually, how do you reconcile that? Like as a personal investor, do you save or do you spend? Like how does that work?
So when we went into this corona crisis, what you saw the new government do is basically try the same trick, but also but through different means. Basically, they asked people to reduce their EPF contribution so that they can actually use the money for short-term needs, which are necessities lah. And this is a good thing. Obviously, if you're in an economic situation where you're out of a job or you really need that extra 500 ringgit to buy fuel for your car, buy groceries, of course you should do it. But basically you're taking from yourself, right? You are shortchanging your own retirement. So it's really not for everyone. But you can see what the government is trying to do. It's trying to spur economy by having people with money in their hands to go out there and buy things. Maybe not necessarily clothes or go to the movies or go holiday, but like to buy necessities so that you have some money flowing in the system. So for those of you obviously who are a little bit more well off, you have job security, you don't really want to be doing this, if the government gives you tax incentives or gives you means of spending your own money, I would say save, continue to save. Don't take all this short-term stimulus to go out there and basically consume and buy things, because it's for your own good, right? It's for your own retirement. It's it's you still have to adhere to financial planning best practices, which is basically you need 6 to 12 months in cash for emergency situations, exactly like what we are in now. And when you invest any money, it's money you can afford to lose and afford to not touch for many, many years. So how does this change what you actually do, right? It doesn't really. So for most of you, I assume, I hope and pray that you guys have job security. But if you really need it, then you need it lah, right? But if you're investing for the long term, the best practice is still to have your cash buffer and to invest money that you can afford to put aside for a long time. So, in terms of how it relates to yourself, right? Don't really bother too much about the economic theory and all that. It's just the rules of financial planning don't go out the window every time an economic crisis hits. So still do the right thing.
Cool. So interesting. 6 to 12 months of that would be, I guess, expenses, not 6 to 12 months of salary, right?
12 months of your salary, because usually people benchmark what they are spending to their salary. So
Wow.
it really means don't spend all you take in, obviously, but you can go about it whatever lah. If you really are super saver, then maybe 6 to 12 months in terms of your expenses. But naturally, for most people, your expenses hopefully won't be as big as or more than your salary, right? So using your salary as a bigger number, a bigger buffer, I think is always better.
Cool. Any thoughts around safe havens, right? And I'll share you a little personal story, right?
Yep.
I predicted, right? I predicted we would go into recession like 4 years ago. So I said, yeah, I'm going to buy a safe haven. I'm going to invest in like precious metals or stuff like that. Ended up buying silver. Why not gold? I don't know.
Why not gold?
I was influenced by Warren Buffett, right? He says that gold is like he said gold is like a useless nugget, don't know whatever, blah blah blah. Anyway, so I bought this 5,000 worth of silver like 4 years ago. Today it's worth 5,250 ringgit. Feels like I wasn't very smart, but yeah. Any thoughts about safe havens, gold?
I think safe haven assets are things that should be in your portfolio at all times. It shouldn't be something that you should rush to when times are bad. So generally what you want to do is get it right from day one. Always have a portfolio that is diversified and balanced and tailored to your own risk level. So in terms of safe haven, it should always be a constituent of your overall portfolio. So what are well regarded safe havens? So it can be things like gold. It can be things like certain currencies like US dollar usually. So these are things that you should have in your portfolio when times are bad. These have shown in the past to have gone up lah. So I don't really have a strong view about silver, but gold has done very well in the last 5 years. It's gone up 50% in the last 5 years, or that's like 7 to 8%. And this is another thing about returns. You should always analyze it. Don't go and listen to the agent and say, oh, this unit trust has gone up 300% since its inception 5 years ago. You should say, oh, what is that in annual terms? Then you come back to reality. Okay, my FDs is 3%. This thing has done 7 to 8%. So is that better or worse? So gold has done 7 to 8% in the last 5 years, basically because things were very uncertain. Before this coronavirus, you had Trump's trade wars, a lot of back and forth between these different economies in terms of tariffs. So people didn't really know what economy will come out better, will come out worse. So basically, they started central banks and investors started buying gold. But if you look at gold 10 years ago, basically it's the same price that it is 5 years ago. So it obviously things have cycles. That's one thing. But also it just shows you that what has done well recently doesn't always mean that you'll do well in the long term. So that's why I always say that that's why you should always look at having a little bit of something in your portfolio. What you shouldn't be doing is jumping from one thing to another. And there's an article I read was basically jumping into safe havens in times like this is the worst thing you can do, because those things are already expensive. Gold is already at 1.6 or something like that, and not 1.1 where it was 5 years ago. So if you go in now, basically you're buying things at a very expensive price with not a lot of upside to go. So even though you think it's a safe haven and you don't want to lose your capital, so let's say worst case scenario, your equity portfolio go down 20%. You're like, oh, I think equity will go down to zero, lose 100%, so I go into gold. But gold is already 20% more expensive than it was a year ago. So you should always, gold is a good thing, safe havens are a good thing, but you should have it in your portfolio from day one, and then not look and jump here and there.
Nice. Any
Hmm.
thoughts about Bitcoin? Favorite topic of mine.
I like Bitcoin as a long-term holding. I think everyone should have at least half or 1% of their net worth into Bitcoin, because you just don't know where it'll go, right? The theory is that the most outsized gains of anything is in the most asymmetric markets. Meaning, asymmetric just means people don't know or don't have information about it. They don't know where crypto or Bitcoin specifically will go in 5-10 years. Because the case for Bitcoin and cryptos is that it can be as universal as money, or it can be worth nothing. And you
Right.
can apply the same thinking to gold. If we go to a zombie apocalypse, gold will be worth something because we can barter, because there's no more fiat currency. But there's also, you can't eat it, right? So like, what's the point of gold? It's just the value that we assign to things. So you don't know whether Bitcoin will be very mainstream or not in the next 5, 10 years, 20 years, right? So as a long-term thing, I think it's fine. If you're in it because you like the volatility as well, like, go for it. But I wouldn't put like 50% of my net worth in it, lah. It's like it's not something that is like super stable. It's very volatile because of the nature of that asset. So I wouldn't put too much in it, right?
Yeah.
So in terms of like what I understand about Bitcoin is, I don't understand all the day-to-day trading. I don't understand all the derivatives that are tied to Bitcoin. But what I like to understand is whether different countries around the world will liberalize their adoption of cryptos. So usually, if a market or a country says, oh, Bitcoin is good, oh, or cryptos is good, let's open up exchanges like Luno, or let's let Bitcoin be tradable in certain parts of the economy, then you see Bitcoin prices go through the roof, because basically it's like, oh, it's adoption, right? Countries have deemed it not to be illegal, so then it goes up in value. So for that, I like Bitcoin. Whether it's a safe haven, I think the jury is still out on that one.
Right.
But I think that as a general investment tool for the long term, which might go to the moon, right? I think always have a little bit there is always great.
Nice. You sound a bit more like a Bitcoin believer than me for a moment. I was a little bit taken aback.
Only for a moment.
Only for a moment. So I'm a little bit mindful of time, right? I know
Yep.
we are running out of time, but I've got like tons of pre-prepared questions. I'm gonna ask you 2 more questions, then
Yep.
we'll go to the sort of audience questions.
Can.
Tons of questions as well.
Yep.
So I guess this is on behalf of my readers.
Yep.
I know there's probably a lot of people listening down who they've been responsible with their money, right? They've kind of been waiting for this day.
Oh,
They've
okay.
got cash now.
Oh, good.
They've played it right, right? They kind of expected this was coming. They played it right.
Yep.
But you have to admit that the fear of getting into markets now is crazy,
Oh yeah,
right?
it's very real.
Crazy
It's very
high.
real.
So
Yeah.
what do you think is a reasonable strategy now?
Yep.
What are some mindsets to go along with that?
Okay. Just very quickly, want to talk about emotion now. So, emotions as an investor is obviously something you need to master. It's like a core pillar of investing, right? And usually, because people are very emotional beings, they don't always do the rational thing and the right thing. So, actually, if you recognize your fear, it's actually a good thing, because you're aware of your own motivations, right? Like what is actually motivating you to do something. Are you hangry, or you just didn't get enough sleep? And like why are you actually grumpy, right? It's like, oh, you need coffee. Okay, get coffee lah, right? So if you're feeling very antsy about your portfolio, it's like, oh, because I have fear. Okay, fear is very normal. And in terms of fear, you're not alone. Everyone is feeling it. Whether you wear a suit, whether you wear a singlet, everyone is feeling fear right now. So what I will say in terms of actually playing it right in this situation is to remember your experiences, at least read about previous crises. If you look at any long-term chart, right, you look at the bottom, you're like, I wish I invest there. And then you look at '08 and you see like, oh, there's a trough there, a bottom there. It's like, I wish I invested there. In '08, the people that made a lot of money, people like Warren Buffett and all that, was were offered investments and offered deals to bail out banks and companies, and that's why they had money at that time to actually participate in these investments. So in terms of what's the reasonable thing to do now, you have to ask yourself two questions. First thing is, do you have spare capital? And if that answer is yes, and you have a stable job, then even better. The second one is, do you have time, right? So we don't know how long this downturn will last in the equity markets. It could be a year before recovery, it could be 2 years, I don't know. But I know that when we recover, it will be a really good thing because you accumulate a lot of investments in this bad time. So obviously, you are not in Genting. It's not Chinese New Year at your uncle's house. You want to silang, you want to go in. Like, if you win, you look like a genius. Like, if you don't, basically you just walk home, your tail between your legs, and it's a bad time for everyone, man. You can't buy me and Aaron drink. Like, it's terrible. So again, with coming back to what to do in this market, first ask whether you have money. Second, ask if you have time. So in our experience, when we talk to sophisticated and high net worth investors in this market now, they are actually calling us because they want to open accounts and they want to put a little bit by little bit by little bit. So you can call it nibble, you can call it drip feed, call it whatever you want. But basically, what you want to do is nibble a bit on the way down, because really you don't know where the bottom is. So if you have a dollar cost averaging strategy already in place, continue that. But if you have more money, even more money, maybe from your savings or for times like this, maybe every time you see the markets go down a lot, that's where you want to pick up a few stocks. So um, personally, what I do is I have a dollar cost averaging program already where I buy StashAway every month, certain amount. But because of this environment, and I see like stocks going down like crazy, every time the market goes down 3-5%, I put extra money in, and that amount is really up to you. And
Right.
because of last 2 days relief rally, I won't say it's like a recovery yet, but it's just like basically the government coming in and saying like $2 trillion, pass a bill, and then the markets were very happy about that, went up 10%, 11%. You can see like all the stocks that you've accumulated in this bad time actually like slowly break even already. So
Cool.
over time, you want to have put in a lot, not a lot, but some money during the bad times, because you don't know whether things will be bad or not. So sum it up
Cool.
just a little bit, just nibble on the way down.
Yep. So you've been putting money in even in a down market, and that's how we know you're gonna be rich in like 5 years, right? I can.
We'll see, man. We'll see. We'll see.
Cool.
So another thing of mine is I want to try as much as I can to be debt free. So I want to pay off this house. So even if in the worst case scenario, all my bets don't pay off, stock market, whatever, at least I still have somewhere to stay.
Okay. So this is the final question from me. Promise. After this, we'll go to submitted questions. So we spoke about the person who's the hustler who's been waiting already for this moment. What
Yep.
about someone younger? Someone maybe
Mm.
just out of college, got a good job.
Yep.
Any other normal circumstance would be on the path to financial stability. Are they screwed now? I mean, they're
It's
I
good.
mean, yeah,
I tell
yeah,
it to everyone. It's like, there's no more hope. We all go home. Well, I think
yeah.
for those who are very new to investing, because you just started working and all that, actually, it's very interesting times. Don't let this crisis pass you by. Um, there's a saying, there's a couple of sayings, when in bad times people get very philosophical. So I think of a lot of sayings.
That's
So the
true.
first
That's true. Yeah.
the first time the first thing is that a crisis is a terrible thing to waste, right? Obviously, it is very tough times in terms of people's health, and there's tragedy all around. But if you're a little bit more removed from that, just learn from this situation about how markets can react, and actually, um, if you see it again when it comes to mini crises along the way, different episodes, you will know what to do. Pick up cheap stock on the way, and also learn about how the market actually works, because you have so many interest rate cuts, so many policy stimulus packages. Read a little bit. Read into what is the intent of all these things, so that you understand the mechanics of the market. Mechanics of the market is not buy stock get rich. It's not that. It's like there's so many inputs. There's the economy, there's people's sentiment and all that. So learn, and then also learn about your own emotion. If let's say you invested in StashAway recently and you've lost a lot of money, let's say you've lost 10%, right? How do you feel? Like, and what do you feel like doing? Then you listen webinars like this, you read things, you ask people, what's the right thing to do? So you're like, oh, okay, should I not panic sell? Okay, then don't panic sell. So you learn about your own emotions. I will also say that for young people, youth is really on your side. You should really look at investing as soon as you are able to, as soon as you earn a paycheck, because compounding really works in your favor. So the earlier you begin, the better it is, because over time you will see your gains compound, even if it is a bond fund, even if it's just FD, just put money aside, just save. I will also say that for new investors, had some notes here. If for new investors, one second, yeah.
Okay.
Yeah, for new investors, yeah, sorry, just referring to my notes. For new investors, it's also really important to know that you need to be intentional about saving for big ticket items like your retirement and for your home or your kids' education, because a lot of young people, and we were all there once. We think like, okay, I can casually save, I can casually put aside money, casually invest, and then hopefully I get there. But what you really need to do is quantify your goals. If let's say your retirement, right, you need 3 million. You're like, how am I going to reach 3 million by the time I'm 60? That means I need to put 500 ringgit a month, or probably more, actually 1,000 ringgit a month, and hope that 1,000 ringgit compounds by 5%, 6% every year to get me to that 3 million. You can't just like, oh no, in my late 40s only, I like, oh, I really want to save for my retirement 15 years away. That's when you're really like, I tell you best practice also, I I cannot help you so much, because the raw material to getting rich is money. Money creates money. And if you're only starting very late and you don't have a lot of time and you don't have a lot of money, things are looking pretty bad. So for young people, you have time and you have a little bit more money, so just start. Just start.
Okay, cool. All right. I mean, we're almost at the end of our scheduled time. So here's what I'm gonna do, right? I think we will extend this slightly. We're just gonna
Extra
go
time.
into
Injury
extra time,
time.
right? Injury time. We're gonna go into question and answer. But I think due to the high number of questions, I'm gonna request Wai Ken, maybe you have to give like short, quick fire answers,
Okay.
right? Like
Okay, I'll try. I'll try.
1-2 sentences. Let's try.
I
We
try.
try. Okay, cool. So here's a question that I picked up. Does StashAway have anything less USA centric?
In few sentences, yes, in the safe one. Less
Okay.
US centric.
Okay.
The more conservative portfolios.
So your what do you call that? Your aggressive portfolios all go for the US stock market.
Yeah.
Okay.
I add another line. It
Okay.
also helps in this situation because the USD is really strengthening. So USD is a safe haven asset. So you see the US dollar has appreciated 6-7% against RM. So having USD in bad times is usually not a bad thing.
Yeah, cool. Yeah, I mean, another point why I like investing in StashAway is because it's denominated in US dollars. So I've kind of got a currency hedge there. If the ringgit drops, USD is still okay. So I have a rather situational question.
Okay.
Maybe, yeah. One of my followers, her name's Katrina, she said she invested since December 2019, SGD 100 every 2 weeks, dollar cost averaging with 22% risk index. Returns are still negative. What should she do? I mean, what can she do right now?
Just stick to your plan. Stay invested. Obviously, since December 2019, markets did very well in December, in January, and in February. But in end February until March, things took a turn for the worse really quickly. Right, in 3 weeks, basically you were down, and it erased a lot of your 2017 returns. But if you dollar cost average and continue, you will basically pick up very cheap stock in this downturn. And when you look back in a year's time, you will see that your decision was correct. So just to clarify also that dollar cost averaging is just a method of investing. It's a discipline basically, but it's not a guaranteed way of making money. It doesn't mean you DCA means you will sure make money. You only make money if your start point is here and your end point is here. Down, you invest low and you sell high. Along the way, you're like this, right? You go like that. So what you if you're in a market which is like this, you DCA also. You're just dollar cost averaging into something that's getting more and more worthless. And I say that this is important because if you look at any long-term trend of US equities or any worldwide equities, the trend is up. If I look at 10 years, 20 years, if you go even longer, the data is even more in my favor in terms of proving my point. So December 2019 is a very short period of time. So keep dollar cost averaging and always remember that what you're investing for to actually continue dollar cost averaging.
Okay, cool. More quick fire questions. Why is there a restriction in terms of people who can sign up for StashAway, those who have apartment and car? Why?
Oh, that used to be the case, no longer.
Really?
So no longer. So basically, if you sign on today, not a problem. Just declare. We only launched, enabled this for those people with borrowings over a month ago, over a month and a half ago. And the underlying portfolios is basically still the same, made out of ETFs into different global investments, balanced and diversified. Okay. So there's no real difference.
So I'm curious now, you're saying that Bank Negara has relaxed their rules, is it?
No. So we basically look at the rules and we comply with them. The rules is basically that you need to invest 50% at least in Sharia investments and 50% in conventional or ringgit. So we look all around the world. We found in the UK that there's some global equities and some emerging market equities, and actually gold is Sharia as well. So what we formed there was 50% Sharia, 50% non-Sharia. We're not marketing it as Sharia, but we are complying with BNM's rules. So technicalities aside, BNM rules aside, just invest like you would normally. Then everything doesn't change, regardless of whether you have a home or how many cars.
Cool. Next question. Tough one. Is it wise to take loan to invest, considering loans are cheap now? Also, why is the advantage of taking loans from bank as compared to investing on margin? I'm going to share my personal thoughts.
Go ahead.
I believe in the principle of never borrow to invest, but keen to hear your thoughts.
Yeah, I don't think that's a tough one. I think that's a very easy one. Just don't borrow to invest because you don't know what the return of your investments will be. So, there's a case to be made if, let's say, you're very sure that your stock has a dividend every year, 5%. If you borrow at, first of all, by the way, share margin is not as cheap as 5%. And single stock some more is not going to give you 5%. You might find some cowboy bank to give you some loan, but generally no. The only thing I would borrow to invest is ASB. And for that one also, I would say the advantages of doing that, you need to do your research. The reason for doing that is basically because you are capped at 400K, right? 200K on one fund, 200K in another fund. And basically you can enjoy the overall benefits at a bigger amount because you borrowed money. And because ASB always gives returns that are positive, first of all, and usually they are like 6, 5.5 like that, then you're fine. If ASB returns you less than the cost of your loan, then basically you're in bad shape because you have to pay that money regardless. Yep. But PNB knows this, and I think basically it will always be above your borrowing rate. And banks have a lot of schemes to give you ASB financing anyway, so the cost will be lower.
Are you, by any chance, able to invest in ASB, Ken?
I think I'm able to, but I just had this stigma that like, Chinese fella cannot, right? So I just haven't. But
really?
I'm pretty sure I can. Okay. I'm pretty sure I can open an account, but I actually have no money in ASB.
Okay, that's interesting. I'm very jealous. I always tell people who can buy ASB to please buy ASB.
Yeah. So we can as well. It's just more readily available for boomies lah. So if your boomie, go out there, man. Don't have any moral quandaries. I won't blame you. So go out there. I have friends who tell me like, I don't really want to do it because most of the time they're actually lazy. But then the second of all, they say like, I don't want to take advantage of my boomie rights. I'm like, that's a very philosophical debate here.
Do it, man. Do it. If you've got the privilege, use it. Yeah. Okay, next question. In light of the huge bazooka of policies launched even
Yes.
faster than usual, do you think financial markets will recover faster than previous crises?
Yeah, yeah. So if you look at previous crises, you will see that every crisis that has every crisis that precedes one another goes down deeper but comes up faster. Right? This is just a trait. I don't know whether this will be the same for the Corona crisis or not, but I think specifically about the policy bazookas, I think what they really do is to not spur a recovery. I think that is just wishful thinking. I also wish that it would bring us out of this mess, but basically the only thing that will bring us out of this mess is containment and cure. What the policy bazookas will do is to put a floor on how deep the recession will go, to bail out companies that need the money, and to help consumers that need the money to ultimately uh, have a more shallow recession. So actually when you look at the recovery, whenever there's a cure or containment, you will see that the recession might be short-lived. But the policy bazooka is not there to bring us up into recovery.
Interesting.
Hmm.
Okay, difficult questions, man. QE
Yeah.
versus repo, what's the difference? And yeah, quick
Ah,
fire answer.
cannot like that. It's like this one. I need to be like Joseph Stiglitz to answer your question. QE is basically the buying of bonds in and usually longer tenor bonds. Repo is overnight money market instruments to basically ensure the financial liquidity of the banks so that banks have money to loan out. So you will see that the financial system has a lot of intricacies, and repo is just to lubricate the bank's financial pipes so that they can lend money to each other and lend money out into the market. But QE is meant for the more for the economy as a whole. But by the way, both have been introduced into the market already.
Okay, I'm gonna go through the final maybe 2 or 3 questions.
Okay.
So and then we'll call it a night lah, huh?
Yep.
REITs, REITs
Yep.
feel like real estate investment trusts, feel like
Yep.
a safe haven. Would that be better than gold? Any performance considerations?
Yeah, so I think actually with REITs, they should be part of any portfolio really. And in fact, some of our portfolios in certain environments also will buy REITs. So you can look at StashAway's list of ETFs to see all of it. And there's some REITs in there, global and US. I won't go so far as to say that REITs are a safe haven, especially now, when let's say malls are not getting any rentals or not getting any footfall. Um, if you own Pavilion and you own KLCC, IGB, I think that they will see some short-term hits. The only reason why you would buy REITs is to get some stable yields or dividends, lah. But at the same time, you shouldn't trade so much because you have capital gains. The REITs also will go up in prices, go down in prices. But what you need to focus on is the yield.
Right. Okay, cool. Market. Maybe a bit of a market question. What do you think of the closing of robo-advisory Smartly? So for context, Smartly was a robo-advisor in Singapore, one of StashAway's competitors, of course.
Yep.
Any thoughts around this?
Yeah, so Smartly never actually launched in Malaysia. I think they had designs on doing so, but in the end they didn't. So they remained in Singapore, and I think it's actually very hard to start and sustain a fintech company, which is why
Right.
you shouldn't just simply invest in anything regardless of whether they are licensed or not. Smartly was also licensed, but just never got that critical mass going. And actually, they've been circling the drain. They've been doing quite badly for a long time because their AUM is very low. And it's a vicious cycle. You can't raise funds. If you can't raise funds, then you can't sustain and grow and also do digital marketing. And therefore, your AUM will decrease or stay stagnant. So in fact, they actually approached us to look at maybe transferring some of their clients to us back before they closed. And then they changed their mind and said that actually the parent company, the partner that they were working with for the license, VCG, a Vietnamese company, which was giving them the license, actually said, oh, actually, I don't think we want to do this. Let's just try running the shop ourselves. So the co-founders actually exited the business at a loss and actually went off to do other things. And then the parent company, VCG, tried to run it for a while. Obviously, now tough times, they just say, let's pull the plug. But if you're in Singapore right now, just go and Google, and in fact, there's actually a way that you can join StashAway from Smartly. So there's a promo and all that going on. So if you're in Singapore, just call our customer support or just Google StashAway and Smartly. There's actually a link that you can click on if you're a Smartly customer to actually join StashAway. So ultimately, obviously, the strong will survive. We are very strong in terms of our equity funding. We raised to date $20 million US dollars, or 27
Wow.
million.
Congratulations.
Thank you. This is all my founders, not me. But this money will see us through in terms of not just sustaining us, but also to continue growing. In fact, we're still hiring. We are still doing all this marketing, as you can see, on Facebook and Instagram. So this downturn is actually a chance for us to get market share because we are built on a very solid foundation.
Cool. Okay, so let me just go through the final few questions. If I didn't get to your question, I'm so sorry, guys, because we've got so many. So unfortunately, can't get to all. Someone asked me, do you happen to have a template for financial planning directed to me? Maybe I'll write an article about that in future. Currently, I don't have one, but I think there's a lot of great articles out there as well on this. I'll look at that maybe in future. Maybe we'll take one last question, right? Wai Ken, do you think it's better to fund SMEs and micro SMEs rather than giving pocket money to individuals? I think this is from a governmental perspective, right? Is it better to inject money directly to people, or is it better to go through the sort of trickle down, go through the businesses first? What do you think?
So for someone who might be future finance minister, obviously, no, I don't know, but I think with anything, right, you need diversification, and diversification in terms of policy is also the right thing to do. And when it comes to public policy for people, I really think that it should be means tested and shouldn't be racial. So that's just my view. Okay, I'm not running for anything, so I'll just say what I think as a personal basis. So if you really want to help people who are disadvantaged, or people who are sick, people who are out of a job, of course you need all the societal support, people in the B40 for fuel, targeted subsidies. I'm a big fan of that. If you want to also have some money for SMEs, I'm all for it. The last thing I want is more cronyism, right? Just for for schemes for these people who apply or whatever. So it needs to be means tested. Are you in an essential industry? Are you in an industry that hires a lot of people? Are you directly affected by coronavirus? Yes, like if you're part of a tourism company now or retail now, I think you've got a good case, but you really shouldn't be just cash for grabs, right? Everyone, then you have no discipline, right? If it's fiscal discipline, and Malaysia is not in the best financial shape because obviously with the oil prices the way they are, China not doing so well in terms of economy, you'll see that we have to be more responsible in terms of how we spend what little money we have, even as a country.
Awesome. Okay, so I'm going to take this question, right?
Go ahead.
Jivanti said, I'm new to this. What should I do? Nope. I actually think a platform like robo-advisory or a platform like StashAway is really a good place for people to get started to learn investing, because I think it kind of allows you to do so in a very non-intimidating way. I can imagine myself if say I was 22 years old, I jumped straight into the stock market. It's a bit intimidating. I think a platform like StashAway is really good. It's diversified, and most importantly, it's the fees are pretty low, right? So you're not getting hit with 5 to 6% fees. So Jivanti, I think if you interested to start investing, maybe not something so high risk like Bitcoin yet, but have a look at StashAway. And yeah, maybe Wai Ken, if you want to share a little bit more about sort of closing thoughts from StashAway or where people can learn more?
Yeah, so I think honestly, I think it's a great way for people to start investing, not just because of all the fees and all that, but also the education that comes along with it. So we do very regular webinars and seminars about personal finance, about investing 101, how to save for your retirement, what are ETFs all about. So when you sign up, you actually will see a lot of content on the app itself, right? So you don't really need to put in money to like get access to all this content. You can actually just download the app and just sign up. You won't be charged anything. So it's about the whole customer experience. It's also not just about like, oh, performance versus performance, right? Like the fact that we do a lot of education, the fact that the app is very simple to use, it's very pretty, it's very seamless. So like, just use that. And also I think that um Aaron has done a lot in terms of helping us get educated as well.
Thank
So
you.
if you look at the links that I posted, basically he's written some reviews on us and the different features that are there. But the key takeaway here is that micro link, that bit.ly link there, you can see that you can get an even better deal by signing up through this link, because you will get 50% off for 6 months. Normally we charge 0.8% for a whole year. So if you invest 1,000, we only get 8 ringgit. 8 ringgit cannot buy a single source coffee also, which is an indulgence, but it's
Right.
actually very, very cheap. So
Okay,
you
you're freezing up
sign up
there.
here.
Wai Ken, are you still there?
Yep, still here. So just click on the link and get 50% off for 6 months. Hello.
All right, cool. Okay, so thanks, guys. Thanks. I really appreciate your time, guys. And big thanks to Wai Ken for coming on the webinar or the show. Maybe we'll make it a regular thing. Again, if you are interested to learn more, check out StashAway. I think Wai Ken has sent a lot of links. And if you are interested to ask a question that wasn't answered, feel free to comment on my Facebook page. That's facebook.com mr-stingy 2014. Let me see if I can unmute Wai Ken, and then I think we'll call it a night. Okay. Wai Ken, can you speak now?
Yes, yep. Thank you so much. Just shared a few links there. Feel free to check it out. Take your time.
All right. Thanks, everyone. Good night. Please stay safe in this virus and take care of your friends, family. Bye.
Yep. Bye, guys. Thank you.